Two companies can have the same stock price and identical market capitalization, yet one might be drowning in debt while the other is sitting on a pile of cash. Are they really worth the same? At first glance, market capitalization might seem like the go-to number for determining a company's value, but it only shows part of the story. To uncover a company's true worth, we need to look deeper. That's where enterprise value comes in. Welcome back to Smart Money, where we break down investing concepts in the simplest way possible. Before we start, a quick disclaimer. This video is for educational purposes only, not financial advice. Market capitalization, the surface-level snapshot. Let's begin with market capitalization, or simply market cap. It is one of the easiest ways to estimate the total value of a company as equity. The formula is straightforward. Market cap equals share price times total outstanding shares, for example. If a company has 10 million shares priced at $50 each, the market cap would be $500 million. You might be familiar with the S&P 500, one of the world's most followed stock indexes. It's actually a market cap-weighted index, which means the larger the company, the greater its influence on the index's movement. While market cap gives a quick sense of how big a company is, it doesn't show the whole financial picture. It tells us what investors think the company is worth, but not what it really costs to own the entire business. Enterprise value. The true worth, that's where enterprise value, EV, comes in. Unlike market cap, EV factors in both a company's debt and cash. Enterprise value equals market cap plus total debt, cash. This gives us a more complete understanding of what a company is truly worth, especially from the perspective of someone trying to buy it outright. Let's look at an example. Company A has a market cap of $500 million. Carries $200 million in debt, and holds $50 million in cash. Company B also has a $500 million market cap but no debt and $100 million in cash. Now let's calculate. Company A 500加250等于650 million EV. Company B 500加0100等于400 million EV. Even though both companies have the same market cap, Company A is effectively more expensive because of its debt. In contrast, Company B looks cheaper and more financially stable due to its strong cash position and zero debt. When enterprise value is higher than market cap, it signals heavy debt loads. When it's lower, it suggests financial strength and flexibility. Why enterprise value matters. EV helps investors see beyond surface numbers. It's what professional analysts use to assess a company's true cost and risk. But the raw number alone doesn't tell you everything. You need to understand why the company has that level of debt or cash. Is it investing aggressively for growth? Facing financial trouble? Or preparing for a major expansion? These details can drastically change how investors interpret the same numbers. EV multiples. How investors use it. Investors often compare enterprise value to other metrics to get better insights. Here are two of the most common ratios. F to EBITDA. Earnings before interest, taxes, depreciation, and amortization. This ratio compares a company's total value to its operating earnings. A lower EV/EBITDA may indicate a company is undervalued, we getting more earnings for your money. A higher ratio could signal an overvalued stock. EV to revenue. This measures how much investors are paying for each dollar of sales. It's especially helpful for evaluating high-growth companies that aren't profitable yet. A lower ratio can point to a more attractive valuation, but keep in mind, it doesn't consider margins, growth potential, or cash flow. These EV multiples are key tools for comparing companies within the same industry, especially when profits differ or when you're analyzing early-stage businesses. Final thoughts. Relying only on market cap can be misleading since it ignores debt and cash reserves. That's why experienced investors prefer using enterprise value. It paints a fuller, more realistic picture of what a company is truly worth. If you found this breakdown helpful, make sure to like, subscribe, and turn on notifications for more simple, smart investing lessons right here on Smart Money. And if you'd like a full explanation of how the S&P 500 index works, let me know in the comments. That might just be our next video. Thanks for watching, and I'll see you in the next one.